So welcome again, once again, everybody. Welcome to our latest webinar. Today we're going to look at two alternative oscillators, indicators that sometimes people don't use or ignore, or just sometimes seem too complicated, but they're actually quite useful. I've used them from time to time. To be honest, I don't use them all the time, but they're sometimes looking at the same thing presented in a different way sometimes just triggers something for some people. So we'll have a look at that today. So as usual, before we get going, let me run through some quick admin. Those of you that don't know me, there's actually quite a few new names in here today, so that's good. Alternative traders or alternative views of guys. So if I speak too quickly, which I have a tendency to do, I apologise now. So just ask me to slow down if I do. Anything you don't understand, just pop it in the question box. Any problems you have with the webinar, sometimes it's either your end with the internet, sometimes our end, or sometimes even GoToWebinar perhaps needs reloading and restarting. So try doing that. Anything I don't explain properly or doesn't make sense to you by the end of the session, send a question to webinars@hotforex.com and I'll get back to you as soon as I can, okay, or the team will. Okay, so welcome again, everybody. So quick run through the disclaimer before we get going. This material is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered an investment advice or an investment recommendation, or indeed a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without our prior written permission. Okay, so that's the admin out of the way. Final piece of admin is me. Those of you that don't know me, have not heard me talk before, my name is Stuart Cowell. I've done lots of different things in my life. You can tell from that photograph, I'm in my early 50s now. Actually mid-50s some would say, but anyway, that's another story. But more importantly, for this role, I've worked in the City of London for nearly 20 years. I worked for investment banks and retail banks predominantly. I've been trading my own account on and off, mostly on, since September 1997. I bought my first proper lot of shares with a few £1,000s, and over that time I could distill the things I've learned into four key things. One, I would say probability. Do something that's probable. If it's probable, do it. If it isn't, don't. Simple as that. Keep it simple. Don't overcomplicate it. Don't have too many indicators on your chart, too many lines and colours and all the rest of it. Sometimes I'm guilty of that myself. Sometimes I have to take a step back. Look at multiple time frames. What's the higher time frame doing? What's the lower time frame doing? The one that you want to trade on. Are you with the trend? Are you against the trend? That helps with the risk management. But most importantly of all, and again, I can talk for hours and hours and hours about this, and I could spend all afternoon or boring you senseless about this final one. Know yourself. You've really, really got to do that. Anybody can learn to look at charts. Anybody can identify patterns. I can teach anybody to trade. What I can't teach you or help you with is yourself, knowing yourself. And you've got to really look yourself in the mirror and decide how you can be a better trader, or the best trader you possibly can. And it's usually about risk management, money management, managing your emotions, discipline, patience, all those boring old words that have been true in the markets for as long as I can remember, and as long as markets have been around, and will be the same for as long as markets still exist, and they'll outlive me, that's certainly for sure. But anyway, that's a whole webinar for another day. And if you've not seen my Mind Games webinar, I would strongly recommend you have a look at it, because it's really, that is the fundamentals for trading for me, or a successful trader for me. So today we're going to look at some alternative indicators. What are alternative indicators? Well, just those that don't get used very often. One's a classic commodity channel index. People see that on their, so it doesn't say channel, it says Chanel, doesn't it? Index, so apologies for that. Um, and just ignore it. Think it's about oil or copper or coffee or wheat, and they don't trade wheat or sugar, and so they think it's not relevant for them. Well, hopefully I'll explain that it is quite a clever little clever little indicator. The other one is percentage R or Williams indicators or percentage Williams, and again, it's a guy called Larry Williams this time. You might be aware of another guy called Bill Williams that talked about fractals and what have you. He's probably a wee bit more famous than Larry Williams, but I'll tell you a little story about Larry Williams when we get to percentage Williams as well. Okay, he's a famous father, or he's a father of a famous actress. But anyway, story for another day, or later today, I should say. Both of them are actually oscillators, so we'll talk about those as well. So any questions you've got now or during the webinar, I say chip it in the box and see if I can help you as we go along. Okay, a different view of technical indicators, I've called this, so alternative indicators. So today we're going to look at these two. Hopefully we won't be too long today. Oscillators. And on our MT4 platform, with lots of other indicators, but these are two I've picked out. The CCI, or the Commodity Channel Index, spelt correctly this time. And on our MT4, it's written as the Williams percent range, or on some other platforms you see it as a percentage in brackets percentage R, and that's how it's quite commonly known as percentage R. Both of these are oscillators. Okay, so let's take a step back about what oscillators are. So oscillators tend to go up and down. Okay, they go from a top they tend to have a range. Some of them. The MACD is an oscillator, but it hasn't got a numbered range. The RSI is numbered between 0 and 100, and the rule is, over 70 is overbought, under 30 is oversold. And so these oscillators are. These two are range bound as well, and we'll look at them as well. Stochastics is another oscillator, and these two are just another alternative oscillator. Okay, so oscillators tend to be best in ranging markets, i.e. when prices are going sideways, the market can't decide where it's going. They tend to have boundaries, but oscillators can also help with, the build-up of energy that moves any price action. The build-up of energy, or the build-up of momentum. So as you can see, a trend starting or running out of energy, or a trend about to start, or a trend about to end, or even a key thing is a change in direction as well. So three different things which we'll look at again as well in a minute. So oscillators, two new oscillators on some you've used before. So can I just ask a quick question before we get started? Who uses oscillators in their trading, whether it's MACD, RSI, or any of these two here we talked about, or stochastics? Presumably, hopefully most of you use some sort of oscillators to help you with your trading. Yeah, MACD, RSI, I do. Okay, good stuff. RSI seems to be the most popular here today. Oops. MACD and RSI, MACD, RSI, MACD. Oh, MACD seems to be the most popular. Okay. So anybody used or heard of CCI, or the Commodity Channel Index, or Williams percentage, and has anybody used it? Well, two questions there, wasn't it? Has anybody heard of it? And secondly, does anybody use it on a day-to-day basis? No. Yes, but I don't follow it. I've used it, heard but never used. Yes. Oh, I've got a yes. Sebastian. Okay. So, Sebastian, do you use it all the time? Do you use CCI or Williams percentage? Sorry, is it Sebastian? I can't see that. Oh, I've got the names. Why won't that come bigger? Can't see. Yes, no, for divergence and CCI. Okay, excellent, good stuff. All right, we like divergence. Divergence is good because it doesn't happen very often. Very good. I was going to come on to that later. Okay, so let's crack on. So oscillators. Come on, chart. So I've stole this from a colleague of mine, or a guy I've attended. This is just a very textbook sort of what is Commodity Channel Index. The Commodity Channel Index, developed by a guy called Donald Lambert many years ago, it's to do with reverses, cyclical price action, the dictionary calls it. One of the fundamental assumptions behind CCI is that price trends reverse at regular intervals within an asset, allowing investors to take an appropriate action where the CCI indicates that one of these cyclical reversals is imminent. So in simple terms, it means that prices follow patterns, and they will do it in cycles or trends or waves, as we call it. I often refer to waves as the waves on the sea. You have a big wave coming in, but it still backwashes. It goes backwards out when it comes in. So if you've got a big destructive wave, it has a big movement forward before it washes backwards. A constructive wave has a little movement in, but a relatively big move backwards. So depending on which direction your price is moving and your asset is moving in, depends on what type of wave we've got. Whether you've got a constructive wave or a destructive wave, as far as the beach analogy is concerned. Okay, so we're looking for these repetitions and these cycles within the or the reversals within these waves. Okay, it's calculated. It's a bit of a mouthful as well when we look at how it's worked out. They talk about true price, and they typically use the 20 period moving average. So we get a line that looks like a very a simple moving average line. Okay, so it's looking at the high, the low, and the closing price and the true price, they call it. Okay, but so these days we don't need to know all this sort of detail. We just click it on our chart, and it pops up typically as a moving average line or a line on our chart. Okay, so CCI, that's how it's put together and that's how it's calculated. Sebastian, there are cycle lines for this in MT4. Yes, indeed there are. Indeed there are. Okay. Sorry, I can't see your full name. It is Sebastian. Sorry, Sebastian. I see it now properly. Okay. So, CCI, what's it good for? It's good for identifying overbought or oversold, like most oscillators. So we can identify these peaks and troughs in the price movement. And like with lots of oscillators, it's great for, as I said at the beginning, you can identify the weakening of the trend. So if the trend's running out of energy, whether the trend itself is actually come to an end, it's rolled over, it's stopped, it's finished, it's the end of the trend, it's not happening anymore. And then we can use it for the next trend, for the change in direction. Okay, whether that's going into a consolidation zone or like a sideways zone, or actual change in direction to go from going up to be going down, or from going down to be going up. Okay, so it gives us this heads up heads up approach. That's the theory of it. Okay, typically it's not typically, but it has a reading of either plus 100 or minus 100. So that's the boundaries for CCI, the channel common channel indicates. So again, the theory says if we're over plus 100, we're in an overbought situation, and the theory says wait for a break down below the 100 again as we go down to suggest a sell position. You go short on that particular asset. If it's under minus 100, we're in an oversold position, and wait for a break back up over the minus 100 to suggest a potential long position. Okay, we'll have a look on a simple as that. So again, it's very similar to RSI and other stochastics and other oscillators as well. But here we've got plus 100 and minus 100. Okay, so over 100 over plus 100 or under minus 100. So here we have what's this? This is the euro dollar on the daily chart from earlier today. So here we see the CCI down at the bottom. I'll come on to the settings in a minute, but this is the standard setting. It comes out at 14 on the MT4 platform. So here you can see the plus 100 and the minus 100 down here. Okay, so every time we break over this line, it's suggesting that we are see if I can change my pencil. We are, so here, let's just bring this in here, we are broke over the 100, so suggesting that we're overbought. So this corresponds up to here as we broke up here, and so you might want to look for a sell position as we go back. Whoops, as we go back here. So that corresponds to that break of that moving average there, that green 120. So on this particular, it's worked out quite well as we've moved down here, and it's been in as the prices moved down, so as the CCI moved down there. So it's paralleled that quite well, hasn't it? So then we wait. It's perked a bit. Oh, it's had another break here. It's broke back down here. So we're saying sell here, but the market has continued to go up in price, hasn't it? As this has gone sideways. So again, we got some price going up, oscillator going sideways, not really helping us. That's why we want to trade. Trending indicators might be better for this situation. So we've stayed a little bit over 100 for this area as we've gone up. We've broken down there. We didn't really move. Doesn't correspond up to here, does it? Sorry, this is all going to get a bit messy with the yellow, but hopefully you can bear with me and see how this pans out. So we had a big break of the about here, and we've got a move down, and we've also got a move down here. So again, convergence. We've had two big move downs on this chart on the daily, and the CCI has perhaps helped us, on the move. But obviously the question is, if you're just looking at the CCI here, we'd have got a few false indicators here, wouldn't we? If we went up and down, over and below the 100 plus 100 here, so we would have got stopped out on a lot of those moves. And the question then, if we'd only been using that, would we have had enough faith to follow it here as it broke down? Well, we may have done, as we, you might have used it with our 20 period moving average for that break there. Whoops, so, excuse me. And we would have got in here, but then we've quickly gone to an oversold situation here, haven't we? And then we've gone back up here, there, as we've gone under the 100 there. Sorry, I didn't mention that before. We got under the 100 there. We broke up to catch that little move there on this side. Okay. So we're under. So down here we're going sideways. We're under the nothing going on really there. We broke up a bit there, which sort of is this line here. So it's not great, but then we've spiked right up over the 100. We got very high here, which corresponds to this top here, the top of the Bollinger Band. So that might have been an interesting one the last few days as we've broke through. So CCI on the daily with a 14 setting is telling us this is a short position, isn't it? As it's a potential short position. So on the daily, you might trigger that. I think the blue one there is the 10 period moving average, or you might want to wait for this green 20 period moving average to break to re-enter any short positions on that euro dollar, just on that simple analysis. Okay, so I hope that made sense. There are some questions coming in here. I don't think it's correct over 40%. What do you think? Salah, I don't know what you mean by that. I don't think it's correct over 40%. Are you saying, Salah, that the CCI is not correct more than 40%? Nagwashi's saying he's muted. How do I fix it? I have to type in a message. Try. It not gives you the right signal. Well, maybe, as with any of these indicators, I say this all the time as well, they are simply that, indicators. If you look up the word indicator in an English dictionary, it will simply say that it's be taken with a pinch of salt, a very big pinch of salt, as with all these indicators, and they all have the same problem. They tend to be lagging. Okay. The only real live indicator is the price. So that's why, again, some traders trade without any indicators at all. Naked traders, they call themselves. They just look at the price action, and everything's built in the price. They argue as true technical indicators, as true price action indicators. Other people say, well, I take it with a pinch of salt. It's a probability exercise, like I talked about at the beginning of the webinar. And take it that way. So wait till it becomes very, very overbought. Wait till it's got over 100 and I don't know, whatever it is, 120, 200. Is that saying it went to 200 and 252 the top here? So wait for that energy to get right up before it rolls over and comes down with lots of power, like it did. You see, that's why it went up quite a lot, because we have these two big. And we can see that in the candle pattern as well. Two big strong up days before it rolled over for 2 days as well and came down, not as half as aggressively as it went up. And that's what the candle patterns are showing us. Again, that's what this pattern's showing. It's gone up and come down half that distance, and so it's still supported by the green line here, the 20 moving average. So combine your indicators, helps you with direction and not relying just on one or two of them. Which indicator is going to confirm what CCI is showing? Well, again, you use them all together. So remember, these are oscillators. So these are good. So you could use them with another oscillator like RSI or like Stochastics, or even percentage Williams, if we have a look at it in a minute. Or you use it with some of your trending indicators, your moving averages, or something like that. So, tend to use a combination of the two, or two or three, so they're all helping you with your decision making. Okay. And again, sometimes it's to do with our own biases, as people, as humans, as traders. So some people like to wait till something's got particularly overbought. It's got really, really stretched. Okay, and so those are the sort of guys that sometimes will have big stop losses or big targets because they know it's gone far too far in one direction, and they're convinced, and they wait until that overstretched situation has got to its think of it as an elastic band. The elastic band's getting stretched and stretched and stretched, and it's got to its absolute limit, and you're pulling it apart, and your hands are shaking, there's so much tension on it, and so it's got to give. And those sort of trades wait for those situations. Other types of trades, again, it's down to your psychology, down to your people. They will stretch as soon as they see any little bit of stretch in the elastic band. That's enough for them to jump in, thinking, well, yeah, it could stretch a bit further, but it's not very likely or probable to get much further before it retraces. And again, you see, that's exactly what all these indicators are doing. They're giving you a sort of a heads up of this, movement, this volatility, this energy in the market, because that's all it is. As I say 100 times, I've said thousands of times over the years, markets go up, they go down, they go sideways. And all we're trying to do as traders is trying to just jump on that move. Not really trying to predict a move, because that's a bit dangerous. You just want to think, what's likely to happen in the next, whatever your time frame is, 5 minutes, 5 days, 5 hours. And that's what you need to decide. And honestly, it can be as simple as that. Sorry, which time frame are we on, Kelvin? Sorry, this is a daily chart. It just happened to be the one I pulled up. Again, indicators. The theory says that technical indicators work on all time frames, and yes, they do. But not all technical indicators are the same, and some are better at higher time frames, some are better at low time frames, and that's what settings is all about. And we're going to come on to that in a minute. Okay. So they all have. Remember, again, they're all mathematical formulas. So they're working on. Excuse me, they're working on price and they're working on time. So, and it's just combinations of that, and that's all it is. And then you add the emotion of a human being looking at it, and there you go. That's what creates the market. Anyway, I've got off the point, which unfortunately I'm quite good at doing. So let's get rid of all that yellow. So settings. So the standard setting on the MT4 platform for the CCI is 14. And this is just my opinion, okay? I'm not saying it's right and I'm not saying it's wrong. However, so 14 for me is okay if you're you're intraday trader. I've seen some people playing with it at 7, and like most oscillators, the lower the number you put on it, the more potential profit you can make and the more opportunity you get, but the more false indicators you can get as well. So it's set as a standard perhaps for a reason. So when you first use it, leave it perhaps as the 14 setting. If I use it, I tend to use it as 20 for the daily time frame. And I know lots of strategists, I know this from personal experience, lots of strategists and these guys you see on Bloomberg and CNBC, if they use CCI, they will use it for their longer term planning. So they'll set it at something like 80 to look at these longer term trends, and so it'll remain under minus 100 for many weeks or months, or over plus 100 for many weeks or months. And that's the issue with this particular indicator and with lots of oscillators, is that they tend to be choppy, i.e. they go up and down a lot, but that's what they do because they're oscillators. But they can end up giving you quite a few false signals. So I'm going to show you the same chart in a minute where it's set at 18. You'll see, so a setting of 14 results in less reactive average touching the either plus 100 or minus 100 less frequently, but it can stay there for longer. So the higher the setting, the smoother the trend, but the less indicators you get. I hope that makes sense. As with all, when you play around with all the settings on all your indicators, the lower you might get more more chances of more saying this is a buy or this is a sell, but the chances of a false trade or a false move is higher. So it's all to do with probabilities. Again, it comes back to my old mantra of risk management and money management all the time, and again, you as a human being and you as a psychological being. So here on this example here, we've got the CCI set at 80, and as you can see, it's minus 100. So it's the same daily chart. So here, this one's saying it's broken back over at let me get that horrible little yellow pen on again. So here in December, it's broken over the minus 100 level here, and it's a buy as far as CCI is concerned, and it's remained a buy all that time, even though it came here. It came quite back yesterday. Was it yesterday or what? Came quite back to close to where you got in. But are you the sort of trader that buys in, makes one trade in December and just leaves it? Probably not. But a strategist that sat in his big glass office in Citibank or in Barclays or JP Morgan, they're the sort of guys that look at these longer term trends. So he's saying, the euro may have recovered from December through to March, and it's looking positive. So who knows? But that's what changing the settings does. I hope that's a quite a simple, straightforward example. But I'll say 14 is as it comes out of MT4. 20 if you're trading off the daily candle sometimes, but leave it with the standard setting. And 60, 80 if you're looking for longer term trends, see where the trend is on the particular chart, without having to look at the higher term time frame. Okay, hope that makes sense again. Okay, so CCI, quite a nice little oscillator. I quite like it. It's not just, I say, people put off it by its title, commodities. It was initially developed for the commodity market, but by this guy called Donald Lambert. But it's good at identifying these reversals. Okay, so it's lots of longer term traders and strategists really like CCI as well, although it does have its place back down, as we saw in the previous chart, back down in the 14 period here, was giving us a number of indicators over this 4 month period. We've had 1, 2, 3. There was a false ones, weren't there? 4. That was a good one. That would have been okay. That would have been okay, and it looks like we've had quite a good one today, or in the last few days on that one, on the set with that 14, because it's RSI, if you look at the others, as I said, moving averages are helping us. RSI's sort of going south, it's not really helping us, and the MACD here is not really helping us. So CCI might have given us a first heads up on that particular one. Okay, so that's CCI. Any particular questions on CCI or anything I've missed or should cover? I know, Sebastian, you talked about it as a divergence, but I'm not going to talk about that today. Okay, but it's like most oscillators, we have these convergences and divergences in them as well. Okay, no questions? Okay, so let's jump on to the second one today, which is a Williams percentage, or percentage R it's called. And again, I've got the same slide I've got from a friend of mine, a colleague of mine. So Larry Williams, and he is actually the father of the lady that was in Manchester by the Sea, a lady actress called Michelle Williams. He developed this along with, it's like the reverse of stochastics. So presumably some of you use stochastics in your trading, and it's really like it's an inverse basically, and it's trying to look at the smooth, the unsmooth stochastics level. So it's an inverse relationship, looking at the K line in the fast stochastics. So as a reciprocal or reverse of the stochastics K line down here, those who do that use stochastics. Okay, and again it's quite straightforward, and there's some key settings and parameters on it which I'll talk about in a wee bit. So here it is, here the purple line here, seen as percentage R, and again it's defaulted to 14. Okay, and we're looking for these overbought and oversold areas. So here we've got the same settings, excuse me, as we have on well, sorry, some settings people have set for their RSI where we're over minus 80 and 90. So sorry, what am I talking about? 80 and 90, 80 and 20, but it's inverse, and that's one of the reasons that some people don't like it or don't use it, because it's a negative number. But you know, if you think of it, just look at the chart, it's the same thing. We're over here. Let's get my nice yellow marker on again. I hope you don't mind yellow. Or should I just do a pen this time? Let's do a pen. So here we're over, and it corresponds here quite nicely. Here we've gone under, and it corresponds quite nicely to this low here. Here we're up over for a while, and it sort of corresponds again. We've got the same problem. We're going up, but this is going sideways. We've topped here. We break down below here quite aggressively, and again that corresponds with our aggressive move down here. I should use a different colour perhaps than red, but you can see that's quite a nice convergence, isn't it? That's quite a nice convergence there, which we've got here as we've moved down. So we've broken that 80 there. So we're under here, and again we've got the same problem going sideways. So we're up, we're down, we're up, we're down, we're up, we're down. So that we probably no good for that one until we stick up here again, our high here again, and down over the last few days again, down through the last few days again. So you know, this isn't a live analysis web shop, but on the daily chart again, our Williams percentage R and CCI and moving averages are suggesting if that, you know, the 20 period breaks on the euro, it's looking to go perhaps back to this sideways level here. So there should be some potential in that, but we got our heads up here as this broke behind the 20 a couple of days ago. Okay, so it's just, as I say, it's just like the stochastics, but there's one key thing with the percentage R that really sort of sets it aside from the other stochastics and the other oscillators, and it's here on this next slide, because the key thing is not so much, well, it is like the others when it's over, but to prevent you from getting these false breakouts, okay, these false moves. That was a nice move up that caught that one, only just, didn't it? One of the key things with the Williams percentage is here on the next slide, because the key thing is the crossing of the 50, and unfortunately the MT4 platform, let's just bring this in, whoops, wasn't that one, where's my slide, where's my slide gone with, it's that one, I want to show you. Unfortunately, the MT4 platform doesn't default the 50 line, so you have to manually put it in yourself. So if we do the same thing again, so we've had this overbought here, so we go around, but what gives it the extra impetus is when it breaks the 50 line. That's not a very bad straight line, Stuart, but there we are. So we've had this overbought, and the bottom of this corresponds with the break of the 50. That's strong energy, so we would have collected a lot of that move there as we've gone sub 50. Actually, we might have done, because we've bounced back up as it's gone back over minus 80. Sorry, over 80. So perhaps, I don't know, we might have got, you know, mind you, we shouldn't have done, because what we'd have got in here, we might have had our stop back up here, and we got the immediate move, we'd have retraced, now we'd have got the bigger energies, we've gone back down again under here. So again, so the key thing you want to write down or make a note from this webinar is the Williams percentage is great you know, stochastics oscillator like most, like RSI and CCI and stochastics. But the key thing is this 50 when we break the line in whatever direction we're going. Okay, so we're overbought, oversold like most oscillators, but it helps us with momentum and momentum failure, which might have helped us at these situations here. So what I'm saying is, don't just look for the breaks going back down below minus 20 as it says here, or the line. Let's just assume the line. Let's just forget what the numbers are. What we're looking for it to do, to add this momentum, which I talked about at the beginning with all oscillators, to give you this energy of the market, the big wave, the direction into the beach, the big constructive wave, is a break of this line here. So here we've come from under here, the blue line I've put on here. So we started here. This is looking interesting, isn't it? Next day takes us through there, so that close there takes us over the 50 and gives us the energy to collect that rise there, which it takes till that point there, and we still keep, but we're still in it because although we've gone over, we've retraced. But the retrace, this is the beauty of percentage Williams, the retrace didn't take us back to 50. And can you see how we've had a few days up, but and again there's extra, you know, ammunition on other indicators, but we didn't get to 50, so we didn't go down, so we kept going up. So whereas before we might have got stopped out here, it's saying confidence to give it keep us in. So here, as we've gone over the line that minus 20s is here, and we haven't dipped under. So again, it would have kept us in this trend. And again, that's a classic indication of the oscillator going sideways, suggesting that they may be running out of energy at some point, which we do eventually up here. But the trending indicator keeping us in the market, and this one is also keeping us in because the momentum hasn't turned down. It's only when we turn down at this point here. It's only at this point here, but look what it does. It corresponds to the break of my old favourite, the 20 period moving average. So it breaks it there. That would give me the confidence that the momentum is coming down now. That's what percentage Williams is telling me. It's also what the candle patterns is telling me. So there's energy in this move. This wave is building, and there we go. We break the bottom line again, and we keep going down. So we capture that move there. We'd capture that move there. I mean, these as with all indicators, these are great after the event. It's having this confidence in the system, and that looks really messy now, doesn't it? Sorry, I hope that is that too messy. It looks messy from here, so I don't know what it looks like on your screens. But hopefully you're getting my point. Basically, the key thing with and the really exciting thing about percentage Williams is this 50, the break of the 50, whichever to give you the crossing, to give you the momentum and the momentum failure. So here's a good one. Okay, we started moving up here. Oh, it's getting really messy, didn't we? See how we got moved up there? We were thinking, oh, is it going to go? Is it going to go? And then, you know, if you'd waited carefully, we didn't break 50. And look at what that corresponds to. What's that called in candlestick patterns? Anybody tell me what that's called? That last thing I've just circled. Come on, somebody tell me what that's called in candlestick patterns. Somebody must know out there. Bravo. Top of the class, gentlemen. Nagwash, Mungsengi. Tweezer top, exactly. Tweezer top. We've had an up. So that's suggesting weakness. That's backed up with CCI, with percentage Williams, because we didn't break the 50, and bang, off we went down the other way. We've broken it. We've gone back up. Is that saying we go back up? No, it's not, is it? Because we haven't broke the 50 again. We got up, we went down. And look at that, what happened? We went sideways. Only when we break the 50 do we look interesting. And that, you know, we might have got stopped out on that one because it's gone up and down quite quickly. And then we've gone back down again. So, you know, it didn't work that time. But as we most, they don't work all the time. That's the beauty of them. A railway line. Thank you, Kevin. I've never heard it called a railway line before, but okay, if you read that in some books. So So sorry, I think I've made that point quite clearly. I hope the 50 line is the key one. Unfortunately, MT4 doesn't put it on, but again, have a play with it. I find it quite good. So here, crossing the 50 is important. You know, we've talked about overbought, oversold, and the 50 gives you this momentum failure. You know, into overbought and overzone, and that's why we get this adding to the 50. And the note here, and I you know, 125 is a bit, you know, it's a bit long for our types of traders, but for a longer term trader, it's good for, you know, 6 months ahead. But most of us are looking at shorter time frames. So the standard, as I said, is set. Let's just go back to my scribbled. I can click all that off, can't I? Erase all link on slide. There we go. So the standard setting is 14 again. But if obviously, as with the other oscillators and indicators, you can play with it. So if you want less of this action, you know, increase your 14 to 20 or 28. If you look again, just like we looked at on the CCI, if you're looking at a longer strategic term view, you know, move it up to, you know, 50 or 100 or something, or play with it. But the standard settings are the standard settings because that's what most people use. So have a go at it. But if you do use it, I would strongly recommend you put in the 50 line, because it is quite fascinating. Is it good to open a position at 50 and close at 80 or 20? Ali, that is a potential pattern or strategy. Obviously, you got to remember as well, we're looking at things that have already happened. Okay, so these are daily charts, and it's happened in the past, and it's quite clear to identify. Let's just click through to that 50. The next, when it's happened, let's get rid of all that. Erase all ink. Okay, and obviously it's very clear here. You know, when that's broken. Remember, on the day that this has happened, it might look as if it's going to be a clear cross at the close of that candle there. Oops, I wish I could draw a straight line. Okay, so that's been our big move, but you know, if you wanted to, whether it actually broke through, whether that purple line actually broke through the 50 there, or you might get a number for what it was. But you know, the other added thing is, in fact, it's broken quite significantly the 20 period move now, so that would add to your argument for going short. So if you'd got short, let's assume we'd done that. Let's assume we'd got short here, and we'd waited to close our trade there. So because this is trending, we that is only you know, we may not have got a big move in that. We've only got that little bit there. If you'd waited to keep, because remember, when it goes through the 20, and sometimes it's the angle that it approaches these lines at to suggest that it's going to have more energy to keep going down. Okay, sometimes if they approach at a flat angle, they tend to skirt along it and don't give you much indication. The steeper the slope, sometimes it can puncture, and it's got more energy to keep going before it turns around. So here we had another 1, 2, 3, 4 days really before it got to the bottom, but this had already started to turn up. So try it, Ali. See if they go. What I would tend to do, I tend to keep it, you know, running a bit longer than once it's punctured the line. Again, depending on how it's approaching it. But again, don't use it in isolation. Use it with all the others. And again, what you've got higher up is a trend forming. You've got in here, the trend keeps going. It's broken the 20 period. It's heading towards the bottom of the Bollinger Band. So you could have had your, you know, if you had your target down here at the bottom of the Bollinger Band, that sort of corresponds to, as it's a really, you know, I'm not very good with these straight lines, am I? It's already turned here, but it's got to its maximum, and that's what you might want to. You might wait till you see the turn in the percentage Williams. But I say I really like it because of this 50 line. You know, it gives you the extra tick in the box for the momentum is really going now. My wave is big, and it's now time to get on it. Oh, it's big enough now for me to get on it. Here we had a go at it and we turned away from it. Here we didn't get to 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 it. So the momentum wasn't strong enough. And look what's happened. It's because the oscillators are now good because we're in a trend. We're going up. So it's only when we break it. That was the first time, wasn't it? So yeah, we could have given us a heads up. We could have, if we'd kept our faith of coming back below the 100. We might have waited till we'd got to that point, the lowest point. Again, if you're drawing the line, the lowest point was there, and that's that big move there. So, you know, it's everything in balance. Oops, no, let's get rid of all that rubbish. It's everything in balance and not using one in isolation, basically. So I hope that's been useful. I've talked for nearly an hour again, which I really wasn't planning to do today. But thank you for your time. Is there any questions at this point about either the CCI or the percentage Williams and how you might apply them, given that they're just an alternative oscillator or another oscillator if you want to add them to your charts as well? Any questions at all? Let me just skip through. Again, this is my, you know, nothing changes there. We're looking at the strength between strong and weak currencies again if we're going to take a trade. Oh, that's an old, where'd that come from? It's an old slide. So again, have a look at the our app if you haven't already got it on your smartphone. And I will see you, where are we? Wednesday. I'll see you next Tuesday for some more live analysis. So Kelvin just stuck his question here. When trading oscillators, is it advisable to trade with different parameters, or I need to use the same for all my oscillators, for example, CCI and RSI? When you say the same, Kevin, do you mean the default settings? Depending on the time frames that you're using. Yes, you know, if you're using a daily, I would have RSI at 14 and CCI set at standard. If you're using intraday, you might want to look at RSI at 7 and, you know, MACD a bit instead of the 12, 26, 5, a bit lower levels. Okay. I hope the recorded version will be available on the site. Yes, actually it will be. Are the same setting for all the currency pairs? Yes. Don't try. That will just drive you mad, Sebastian, if you're changing currency, unless you're a very sophisticated trader and you've noticed the nuances within each currency pair, that you can do that. But most of us aren't that sophisticated. Not yet, he says. Okay, nice comment. So yes, don't try and mix it. Remember what we're doing. Okay, we're looking for either trends or ranges or channels. So we're looking to get in at the beginning of a trend or a good trend or a strong trend, or we know that a channel's going sideways, so we're just getting in at the bottom and selling at the top. So we want to be doing what the rest of the market's doing. And remember, most of the market's using things set at standard settings. Don't waste your time tweaking these indicators to try and find the, excuse my phrase, the holy grail, you know, the nirvana of, like, if I can just change my stochastics, or I can just change my MACD, instead of it being 12, what if I change it to 10, or if I change it to 11? What if RSI is 8? Everybody's using 7 or 14. What if I try 8? I bet I can beat the market. It's not like that. You know, most of the market is doing what most of the market's doing, and that's why, you know, I love Fibonacci as well, because Fibonacci is just you know, the masses, you know, all of us thinking the same thing. So, and you see it all over the place, and especially in the financial market. So don't try and waste your time tweaking these things. It's really not worth it. Okay. On daily, when you place your trades, I don't know what that question means, Glothron. On daily, when you place trades, I don't know what you mean. On daily. Daily or any type of trade, you wait till your candle's closed. Okay. If you trade in the hour chart, wait till, you know, the hour candle's about to close in a minute, isn't it? In a couple of minutes. So you shouldn't be open. You should be having a look now, see if the things are going to happen. It's obviously not going to change much now, but, you know, some things can change quite aggressively on the hour, because some of these robots and some of these algos have things programmed by the time as well. So wait till your candle's closed. Let's say I am trading daily chart. I will need to put 14 period RSI and then 14.2 on CCI, or can I use different settings? No, try those twos, 14 Kelvin, sorry, and see how you get on. Okay, good. Nice comment, Kelvin. Appreciate that. Okay, so thanks for your time, everybody. I'll be back on Tuesday with some more live analysis. Here's my books, or the books I recommend. If you only ever buy one trading book, buy that one at the top there, The Reminiscences of a Stock Operator. It's sat here in front of me, my second or third copy of it. First one fell to pieces. If you're brand new to trading, get Anna Cooling's Forex for Beginners book as an ebook. I think it's only published in the States, but she's an Italian-English lady, works with her husband. She's got her own website. She's very good. Great little book if you're new. And I will see you all next Tuesday, hopefully. Any questions, send it to webinars@hotforex.com. And thank you very much for your time. I'll see you all again next week. Have a great weekend. Bye-bye.